I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. These are the golden words told by the legendary stock market investor Mr. Warren Buffett. Investing in stocks is a great way to build wealth by harnessing the power of growing companies. Getting started can feel daunting for many beginners looking to get into the stock market despite the potential long term gains, but you can start buying stocks in minutes. So, how exactly do you invest in stocks? It's actually quite simple. You have several ways to do it. One of the easiest ways is to open an online brokerage account and buy stocks or stock funds. If you're not comfortable with that, you can work with a professional to manage your portfolio, often for a reasonable fee. Either way, you can invest in stocks online and begin with little money. But before starting, YouTube G is telling me that only 23.9% of you are only subscribed. So please subscribe if you like the videos that we make. Before understanding how to invest in stock market, let's know what stock market firstly is. In simple terms, the stock market is a marketplace where financial instruments are traded, which is stocks, bonds, ETFs, etc. The two primary stock markets in India, the National Stock Exchange, which is called NSE, and the Bombay Stock Exchange, which is called the BSE. The NSE is by far the largest with over 90% of cash trades. There are also other exchanges for commodities like the Multi Commodity Exchange and the Indian Energy Exchange for power trading and so on. All activities are participants to the stock market, including day to day trades, instruments being traded, exchanges that enable the financial instruments to be traded, are regulated by the Security Exchange Board of India, SEBI. You cannot buy or sell directly on the stock market. For this, you have to go through brokers who are authorized to trade on the market or stock brokerage companies that allow you to trade using their platform. The process is actually very simple. To begin investing, you have to open a trading account with a broker or a stock brokerage platform. A trading account is where you actually trade or place or sell, buy or sell the orders. The broker or the stock brokerage platform opens a demat account for you. A demat account holds the financial securities in your name. These two accounts are then linked to your bank account. To open a trading and demat account, you need to provide Know Your Customer KYC documentation that includes verification via government authorized identity cards such as the PAN card or your Aadhaar card. Most brokers or brokerage platforms now have an online KYC process that allows you to open an account in a couple of days by submitting your verification details digitally. Once open, you can trade with your broker or brokerage company online via a portal or offline via phone calls. When researching for stocks or mutual funds to invest in, you will come across the term market cap. Market cap or market capitalization is the value of 100% of the company. Put simply, if I say a company's market cap is 10,000 crores, it means that is how much money it would cost me to buy all the shares of the company. Based on the market capitalization, three types of stocks categorization exists. It is important to know this because many mutual funds are classified based on the market caps they focus on. Large cap stocks. SEBI defines large cap stocks as the top 100 stocks by market cap. These companies are some of the largest companies in the country by revenue, are well established, and are usually market leaders in their respective industries. These are seen at least risky but may not grow as fast as mid or small cap stocks, but they may offer higher dividends and a safe capital reserve in the long term. Second are mid cap stocks. SEBI defines mid cap stocks ranked from top 101 to 250 by market cap. These usually implies to companies with a market cap in a range of between 8,000 crores to 25,000 crores. These companies are smaller than large cap companies capable of higher growth and the potential to disrupt a large company or grow into a large company itself. They are considered riskier than large caps but less risky compared to small caps. The third and the final one are the small cap stocks. All stocks ranked below top 2251 and below by market cap are considered small caps by SEBI. These are the stocks from small companies and are highly volatile. Compared to other two, these are seen as quite risky but have the potential for higher returns. Small cap stocks are also less liquid, that means less amount of trade is being done in these stocks, which means that there aren't many buyers and sellers for these stocks as for large caps. Decide your risk appetite. Risk appetite is the amount of risk that you can withstand. Several factors influencing risk appetite includes the timeline of investment, age, goal, and capital. Another key is variable to keep in mind is your current liabilities. For example, if you are the sole earning member of your family, then you will be less inclined to take risks. Here, maybe you will have more debt, large cap stocks in your portfolio. On the other hand, if you are younger with no dependents, you may have high risk appetite. This may allow you higher exposure to equities versus debt. Even with equities, you may be able to invest in more small caps, which are higher risk stocks. The starting point is to make a choice, keeping in mind that risk and reward go hand in hand. Invest regularly. Now that you have a demat account, you need to allocate funds for regular investment. Set a personal budget, track your expenses, and see how much you can set aside. The best way to invest in the market is to use a systematic investment plan (SIP). A SIP is investing the same amount of money every month in, say, a mutual fund. This allows you to make an average that the different market levels you come in at. Maintain good investing habits and slowly increase your investments as you gain confidence in the market. Build a diverse portfolio. The basic rule for building any portfolio is to invest in a diverse range of assets. This because it minimizes the impact if a certain asset performs badly. Diversification extends within the asset class, industry, and cycles. It may be tempting to park all your money in an industry that is an upward swing, but it is always better to distribute between industries, balancing market cap exposure and offset the risk of equity shares with stable but lower return bonds. Finally, use SIPs to make sure you have invested in securities across different market cycles to keep you safe. As your priorities change with time, your portfolio must also change to reflect this. You must rebalance your portfolio every couple of quarters to make sure you are not over or underexposed to any one stock or asset class. This is also necessary as you grow older and your priorities change. For instance, you may want to lower your risk when you start a family or when you are nearing retirement age. Anyone can invest in the stock market. It is a life skill that needs to be owned, and like all good things, but it needs little patience, time, and study. With thoughtful investment, you can make your money work for you and achieve your goals and dreams.